I get asked this question constantly. Ray, should I invest in real estate or stocks? Which is better? And the answer, like most things in investing, is it depends, but not in a vague, unhelpful way. I can give you a very specific framework for thinking about this question. Because over 50 years of investing, I've studied both asset classes extensively. I've owned both. I've seen both perform brilliantly and terribly depending on the environment. And what I've learned is this. The question isn't which is better in absolute terms. The question is which is better for you, given your specific situation, goals, and the current economic environment. Today, I want to break down this debate systematically, not with emotional arguments or anecdotes, but with data, frameworks, and clear thinking. What we'll cover: the fundamental differences, how stocks and real estate actually work; historical returns, what the data shows over decades; the pros and cons, honest assessment of each; economic environments, which performs better when; your personal factors, how to decide for your situation; the hybrid approach, why you might want both. This isn't about me telling you buy stocks or buy real estate. This is about giving you the framework to make an intelligent decision for yourself. Let's start with the fundamentals. The fundamental differences. Before we can compare returns or analyze pros and cons, we need to understand what these assets actually are, because they're fundamentally different in how they generate returns. When you buy a stock, you're buying a small piece of a business. That business employs people, produces goods or services, generates revenue, hopefully earns profits, and returns cash to shareholders through dividends or buybacks. Your return comes from two sources. First, capital appreciation. The price goes up. If the company grows earnings, the stock price typically rises over time. Second, dividends. The company distributes a portion of profits to shareholders. Key characteristic: you're a passive owner. You don't manage the business day to day. Professional management does that. When you buy real estate, let's focus on rental property, not your primary residence. You're buying a physical building on a specific piece of land in a specific location. Your return comes from two sources. First, rental income, cash flow. Tenants pay you monthly rent. After expenses like mortgage, taxes, insurance, maintenance, property management, what's left is your cash flow. Second, appreciation, property value increases. Over time, the property might increase in value due to location appreciation, improvements, or inflation. Key characteristic: you can be an active owner, manage it yourself, or passive, hire property manager. But either way, you're more involved than with stocks. The core difference is this. Stocks equal productive business capital. Returns driven by business growth, innovation, operational efficiency. Real estate equals fixed physical asset. Returns driven by location value, rental demand, inflation, financing leverage. This fundamental difference affects everything else: returns, risks, tax treatment, liquidity, time commitment. Understanding this is critical before we compare them. Historical returns, what the data shows. All right, let's look at actual historical performance. Because opinions are one thing, data is another. For U.S. stocks, the S&P wink with tongue sticking out 500 from 1926 to 2024, nominal returns averaged around 10% annually. Real returns, after inflation, around 7% annually. With dividends reinvested, about 10.3% nominal, 7.3% real. If you invested $10,000 in 1926, by 2024, that would be roughly $140 million in nominal terms, or about $1.5 million inflation adjusted. But this comes with volatility. The worst year was negative 43% in 1931. Standard deviation is around 20% annually. Significant drawdowns happen every 7 to 10 years. For U.S. real estate, national home prices from 1926 to 2024, nominal returns averaged around 3.8% annually. Real returns, after inflation, only around 0.3 to 0.5% annually. Wait, that seems terrible compared to stocks, right? But there's a critical distinction here. This is for unleveraged, unrented residential real estate. If you use leverage with a mortgage, generate rental income, manage actively, and buy in good locations, the returns change dramatically. Let me give you a typical leveraged rental real estate scenario. Say you buy a $500,000 property. You put down $100,000. That's 20%. You get a mortgage for $400,000 at 6% interest. Gross rent is $3,000 per month. That's $36,000 per year. Your expenses, taxes, insurance, maintenance, vacancy run about $18,000 per year. Your net cash flow is $18,000 per year after mortgage payment. Now, let's calculate the return. Your cash-on-cash return is 18%. That's $18,000 net divided by $100,000 down payment. Plus, you get appreciation around 3 to 4% on the $500,000 property value, plus tax benefits like depreciation and mortgage interest deduction. Your effective return is 15 to 25% on invested capital. But this requires time for property management, expertise in finding good deals and managing tenants, risk from vacancies, major repairs, bad tenants, and illiquidity because you can't sell quickly. So which is better? If comparing unleveraged real estate versus stocks, stocks win decisively, 10% versus 3.8%. Leveraged, well-managed rental real estate versus stocks, real estate can match or exceed stocks, but with more work and different risks. The key insight is this. The 10% versus 3.8% comparison is apples to oranges. Stocks give you leveraged exposure to business growth without you doing anything. Real estate gives you potential for high returns if you use leverage intelligently, generate rental income, manage actively or hire good managers, and buy in good locations. It's not that one is universally better. They're different asset classes with different return drivers. Pros and cons. Honest assessment. Let me give you an honest, balanced assessment of each, because both have genuine advantages and disadvantages. For stocks, the advantages are liquidity. You can sell stocks in seconds. Get your money within 2 business days. Try selling a house that fast. Divisibility. You can own $100 of stock or $100,000. With real estate, minimum investment is typically much higher, a down payment on a property. True diversification. With $10,000, you can own pieces of 500-plus companies across every sector and geography via index funds. With real estate, that same $10,000 might not even cover a down payment on one property. Passive management. Buy an index fund, don't think about it for 30 years. No tenant calls at 2 a.m. about broken pipes. Lower transaction costs. Buying stocks costs around 0 to 0.5% commission. Buying real estate costs 5 to 8% in closing costs and realtor fees. Professional management included. Companies have professional CEOs, CFOs, operations teams. You benefit from their expertise without doing the work. No maintenance. The company maintains its own assets. You don't fix roofs or replace HVAC systems. The disadvantages of stocks are volatility. Stock prices swing wildly. -20 to -40% drawdowns happen regularly. Psychologically difficult for many people. No leverage typically. Unless you use margin, which is risky, you can't leverage stock investments the way you can with mortgages. No control. You don't control business decisions. Bad management can destroy value. Mark-to-market daily. You see your portfolio value change every day. This can lead to emotional decisions. No tax benefits in taxable accounts. Dividends and capital gains are taxed. No depreciation deduction. Feels abstract. You own shares of something intangible. For some people, this feels less real than owning a building. For real estate, the advantages are leverage through mortgages. You can control $500,000 of property with $100,000 down. If property appreciates 5%, you made 25% on your down payment. 5% of 500,000 equals 25,000 gain on 100,000 invested. Rental income, cash flow. Stocks might or might not pay dividends. Rental property generates monthly income if managed well. Tax advantages in the U.S. mortgage interest deduction, property tax deduction, depreciation, which reduces taxable income even while property appreciates, and 1031 exchanges to defer capital gains. Inflation hedge. Rents typically rise with inflation. Your mortgage payment stays fixed. Over time, cash flow increases. Tangible asset. You can see it, touch it, improve it. For many people, this feels more real than stocks. Control. You choose the property, the tenants, the improvements. You control value creation. Force savings. Your tenants pay down your mortgage principal every month. Builds equity automatically. Less psychological volatility. Your property isn't marked to market daily. If property values drop 10%, you might not even know. This can actually be an advantage. You're less likely to panic sell. The disadvantages of real estate are illiquid. Selling a property takes months and costs 5 to 8% in transaction fees. High minimum investment. Even with leverage, you need $20,000 to $100,000 plus for a down payment. Difficult for beginners. Concentration risk. Your $100,000 down payment buys one property in one location. If that market crashes or that tenant is terrible, you're in trouble. Time commitment. Property management is work. Even with a property manager, you're involved in decisions, maintenance, tenant issues. Vacancy risk. No tenant equals no income, but you still have mortgage, taxes, insurance, maintenance. Maintenance and repairs. Roofs, HVAC, plumbing, appliances, these break and are expensive. Budget 1 to 2% of property value annually for maintenance. Bad tenants can destroy your property, stop paying rent, require costly eviction process. Leverage cuts both ways. If property value drops, leverage magnifies losses. In 2008, people lost homes because they were over-leveraged. Local market dependent. Your return is heavily dependent on your specific local market. Detroit real estate performed very differently than San Francisco over the last 30 years. Transaction costs. Buying and selling property costs 6 to 10% total in closing costs and realtor fees. This eats into returns, especially if you don't hold long-term. The balanced view is this. Both have genuine advantages. Both have real disadvantages. Neither is universally superior. Economic environments. Which performs better when? Here's a critical insight from 50 years of studying markets. Performance depends heavily on the economic environment. Let me break down which asset class tends to perform better in different conditions. Environment number 1. Strong economic growth. The winner here is stocks decisively. During strong economic growth, GDP growing at 3 to 5% or higher, several forces benefit corporate earnings. First, consumer spending accelerates. People feel confident and spend freely. Second, business investment surges. Companies build factories, hire aggressively, increase and amp winking and laughing. This creates a feedback loop. More investment, more jobs, more spending. Third, innovation accelerates. The 1990s dot-com boom is a perfect example. Amazon, Google, eBay all emerged during this expansion. Fourth, and this is critical, profit margins expand. Companies achieve operating leverage. Fixed costs stay stable while revenues grow rapidly. Example, a company earning $100 million in revenue with 10% margins makes $10 million in earnings. Revenue grows 50% to $150 million, but margins expand to 15%. Earnings grow to $22.5 million. That's 125% earnings growth from only 50% revenue growth. Stock prices follow earnings, creating explosive returns. Fifth, valuation multiples expand. During boom times, investors pay higher price-to-earnings ratios. A stock at 15 times earnings might expand to 25 times. You see stocks returning 20, 30, even 40% annually. Real estate during strong growth? It benefits, but much less. Rents increase, property values appreciate, vacancy rates fall. But real estate can't expand margins like businesses. Your costs are fixed. Property taxes, insurance, maintenance don't decrease. In fact, repair costs often increase as contractors get busier. While rental income might grow 5%, Net operating income might only grow 3%. Property appreciation typically runs 3 to 6% annually. Even with leverage, that's 6 to 12% returns on your equity. Good, but trailing stocks at 15 to 20%. Historical example, the 1990s. S&Amp wink with tongue sticking out, 500 returned 18% annually. Real estate appreciated 4 to 5%. A $100,000 stock investment grew to $470,000 by 2000. That same amount in real estate, even with leverage, might have grown to $250,000. Stocks dramatically outperformed. Why? Strong economic growth is about productivity gains and innovation. Businesses are the engines of productivity. They invest in technology, create new products, enter new markets. Real estate is passive. A rental house doesn't innovate. It just sits there, slowly aging. During productivity surges, productive capital outperforms fixed assets. Plus, during strong growth, the Federal Reserve often raises interest rates to prevent overheating. Rising rates hurt real estate more directly. Mortgage rates increase, reducing affordability. Stocks can overcome rising rates if earnings growth is strong enough. Bottom line, in strong, sustained economic growth, stocks win. They capture productivity gains, innovation, margin expansion in a way real estate cannot. You should be overweight stocks during these periods. Environment number 2, moderate inflation, 2 to 4%. This is what I call the Goldilocks environment, not too hot, not too cold, and both stocks and real estate perform quite well here. Stocks in moderate inflation. Companies can pass cost increases to customers without losing demand. If costs go up 3%, they raise prices 3%, margins stay intact. Companies like Coca-Cola, McDonald's do this easily. Moderate inflation also means healthy economic growth. People are working and spending confidently. The Federal Reserve stays calm, not aggressively hiking or cutting rates. This stability is excellent for stocks. Real estate in moderate inflation. This is where real estate really shines. The magic is fixed-rate mortgages combined with rising rents. Say you bought a rental property with a 30-year fixed mortgage at 5%. Your mortgage payment never changes. But if inflation runs at 3% annually, your rents rise 3% per year. Example, year 1, rent is $2,000 per month. Mortgage is $1,500. You're breaking even. Year 10, rent has grown to $2,690. Mortgage is still $1,500. Your cash flow exploded. Year 20, rent is $3,600. Mortgage still $1,500. Enormous cash flow. The inflation erodes your debt while increasing your income. Property values also appreciate at inflation rate, plus a local premium. 3% inflation plus 2% local growth equals 5% appreciation. With 20% down payment, that's a 25% return on your equity. Add growing cash flow, you're generating 12 to 15% total returns. Plus, construction costs rise with inflation, making new supply expensive. This supports existing property values. And depreciation deductions are based on original purchase price, not current inflated value, creating valuable tax shields. Real example, 2010 to 2019. Inflation averaged 2 to 2.5%. S&Amp wink with tongue sticking out, 500 returned 13 to 14% annually. Real estate in growing markets returned 10 to 12%. Some markets like Austin hit 15% plus. The verdict, both work well. Stocks have a slight edge in returns, 13 to 14% versus 10 to 12%. But real estate offers tax advantages, less volatility, and tangible assets with predictable income. For most investors, stay balanced. 60% stocks, 30% real estate, 10% bonds. The mistake is chasing recent performance. The smart move is rebalancing regularly. Take profits from winners, add to underperformers. Key insight: moderate inflation environments last for extended periods. 5, 10, even 15 years. The 1990s were like this. The 2010s too. Both asset classes deliver solid returns. This is why I emphasize owning both rather than trying to pick a winner. Environment number 3, high inflation, 5% plus. Winner, real estate, leveraged. Why? Rents rise rapidly with inflation. Property values increase with inflation. Fixed-rate mortgage payments stay the same, so real cost declines. Tax benefits increase with higher income. Stocks struggle because inflation forces Fed to raise rates, which hurts valuations. Example, 1970s stagflation. S&Amp wink with tongue sticking out 500 returned around 5% annually. Terrible in real terms after 7% inflation. Real estate saw 8 to 10% appreciation plus rising rents equals strong real returns. Environment number 4, recession/economic contraction. Winner, neither, both struggle, but stocks recover faster. Why stocks struggle? Corporate earnings fall, unemployment rises, stock prices decline 20 to 40%. Why real estate struggles? Vacancy rates increase, rents stagnate or fall, property values decline, foreclosures increase if overleveraged. But stocks typically recover within 1 to 3 years. Real estate takes longer, 3 to 7 years. Example, 2008 financial crisis. S&Amp wink with tongue sticking out 500 down 37% in 2008, but back to peak by 2013. Real estate down 30% from 2006 to 2011. Took until 2016 to 2017 to recover in most markets. Environment number 5, deflationary depression, rare. Winner, cash and bonds. Both stocks and real estate get crushed in deflation because prices falling equals revenues and rents falling. Debt burdens increase in real terms. Asset values collapse. Example, 1930s Great Depression. Stocks down 80% from 1929 to 1932. Real estate down 50 to 70% from 1929 to 1933. Environment number 6, financial crisis/credit crunch. Winner, stocks eventually. Real estate is especially vulnerable because it depends on credit availability. If banks stop lending like in 2008, real estate transactions freeze and prices collapse. Stocks don't depend on credit the same way, so they recover faster once credit normalizes. The takeaway, there's no always better asset class. It depends on the environment. Strong growth favors stocks. High inflation favors leveraged real estate. Moderate growth with moderate inflation, roughly equal. Recession, both struggle, but stocks recover faster. Credit crisis, stocks recover faster. Understanding economic cycles is critical to knowing which to favor. Your personal factors, how to decide. All right, beyond the economic environment, there are personal factors that should heavily influence your decision. If you have limited time, favor stocks, specifically index funds. Set it and forget it. No tenant management, no maintenance, no 2 a.m. phone calls. If you have time and enjoy real estate, favor real estate. Can generate higher returns if you're good at it, but requires learning the business. Property management, tenant screening, maintenance, market analysis. My view, don't invest in real estate unless you're willing to treat it like a part-time job or hire a property manager, which reduces returns. If you have $5,000 to $50,000, favor stocks. Can't buy investment property with $5,000. Can build diversified stock portfolio with $5,000 via index funds. If you have $100,000 plus, both become viable. Enough for down payment on investment property or diversified stock portfolio or combination. If you can't handle volatility, favor real estate paradoxically. Not marked to market daily. Don't see value fluctuations. Monthly rent checks feel stable. Note, the risks are still there, vacancy, repairs, but feel different. If you can handle volatility, favor stocks. Will experience 20 to 40% drawdowns, but historically recover and compound well. Need emotional discipline not to panic sell. If you might need to access capital quickly, favor stocks. Liquid can sell in seconds. Emergency fund should be separate, but stocks are accessible. If you can lock up capital for 5 to 10 plus years, favor real estate. Illiquidity is fine if you don't need the money. can actually be an advantage, forces long-term thinking. If you might move frequently, favor stocks. Location independent. Don't need to manage property remotely. If you're rooted in a location, favor real estate. Easier to manage local properties. You understand local market. Can inspect and oversee directly. If you're in high tax bracket in the US, real estate has edge. Depreciation shields income. Mortgage interest deduction. 1031 exchanges defer gains. If you're in low or moderate bracket, stocks work fine. Long-term capital gains rates are favorable. Dividends taxed at preferential rates. If you're analytical, passive, prefer simplicity, favor stocks. If you're hands-on, enjoy problem solving like tangible assets, favor real estate. There's no right answer, it depends on you. The hybrid approach and AMP. Conclusion. Here's what I actually recommend for most people. Don't choose. Own both. Instead of real estate versus stocks, think real estate and stocks. Why own both? First, diversification. They don't always move together. In 1970s, real estate outperformed. In 1990s, stocks outperformed. Owning both smooths returns. Second, different risk profiles. Stocks carry market risk and volatility. Real estate carries tenant risk, maintenance risk, local market risk. These risks are largely uncorrelated. Third, different cash flow profiles. Stocks provide primarily appreciation and some dividends. Real estate provides steady monthly cash flow plus appreciation. Combination provides both growth and income. Fourth, different tax treatments. Benefit from both stock tax rates and real estate tax advantages. Sample allocation depending on age and life stage. Young investor, 20s to 30s, 70 to 80% stocks for high growth potential and time to recover from volatility. 10 to 20% REITs for real estate exposure without management burden. 10 to 20% saving for first investment property down payment. Mid-career, 40s to 50s, 50 to 60% stocks. 20 to 30% direct real estate, 1 to 2 rental properties. 10 to 20% REITs or bonds. Pre-retirement, 50s to 60s, 40 to 50% stocks. 30 to 40% real estate, paid off or low leverage. 10 to 20% bonds or cash. Retirement, 65 plus. 30 to 40% stocks for continued growth. 40 to 50% real estate for cash flow and income. 10 to 20% bonds or cash for stability. If you want real estate exposure without the work, consider REITs, real estate investment trusts. They trade like stocks, liquid, professionally managed, diversified across many properties, required to pay out 90% of income as dividends. Returns similar to direct real estate historically. Pros of REITs: liquidity, diversification, no management burden, lower minimum investment. Cons of REITs: no leverage since you can't use mortgages, no control, no tax advantages of direct ownership, mark-to-market daily, which means volatility. My personal allocation: I own both stocks and real estate. Significant stock exposure through various strategies. Own primary residence, paid off. Some investment real estate, but managed by professionals. Prefer stocks for most of my liquid wealth due to liquidity and diversification. But I recognize real estate has worked brilliantly for many people, especially those who have time and expertise, buy in good markets, use leverage intelligently, and manage actively. The final answer to which is better, real estate or stocks. For most people, stocks, index funds, because they're easier, more liquid, more diversifiable, lower time commitment, and historical returns are excellent. But real estate can be better if you have time and expertise, can use leverage safely, are willing to actively manage or hire good managers, buy in good locations, and hold long-term. The optimal strategy: own both in proportions that fit your life stage, goals, and preferences. Don't let this be an either or question. Make it an in question. Build wealth through stocks for liquid, diversified exposure to business growth, and real estate for leveraged, cash-flowing, tax-advantaged wealth building. And most importantly, start, whether with stocks or real estate, The biggest mistake is not investing at all because you're paralyzed by the debate. Pick one, start investing, learn from experience, and add the other over time. Thank you for watching.